You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
Welcome back to Options Bootcamp, the program where we take you, the basic retail trader. Maybe you're an equity trader, maybe you're beginning to dip your toes into the options waters, and we help break you down, break you of all those horrible, horrible bad equity trading habits, and then we rebuild you into a seasoned options veteran. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs on said network, a baker's dozen, if you will, worth of options programming, excitement, and extravaganza even for you there. Where can you find all of those great programs? Well, of course, the mothership, theoptionsinsider.com. You can click on the Insider Radio Network tab, and all of our shows will pop up there on that overlay. Just choose the show you want, and you're off to the races. You can, of course, check out all of the many archived episodes there of the Options Bootcamp program. I encourage you to start from episode 1 and work your way through. By the time you get through all these episodes, you'll be feeling like a pretty seasoned options veteran, let me tell you. Of course, you can also find them on iTunes, Stitcher, Aha Mobile. If that's too much work for you, then just go download our mobile app. It's all baked into there, available for iOS, Android, even the Fire OS. All right, and joining me on the old Options Bootcamp program today, joining us via the magical technology known as the telephone, because none of the Skype gods seem to be smiling on us today. You know him, you love him as the founder of Market Taker Mentoring, as well as the author of a myriad of options tomes, Mr. Dan Passarelli. Dan, welcome back to the program, sir.
Oh, Mark, it's fantastic to be back on this lovely Chicago winter day.
It is quite lovely and scenic, isn't it?
Yeah, I mean, it's a relative thing, subjective, if you will, but sure, we can call it lovely.
Certainly better than being on the East Coast right now, where they're getting just lambasted with a lot of snow. So we get a little bit of the cold here, not as much snow. I think we'll take that trade-off. All right, with the gang assembled, with our hats on and our whistles ready to go, we're going to dive right on into our basic training segment.
Time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, and welcome to the basic training segment. This is indeed the portion of the program where we break down some interesting and indeed basic, as the name implies, options concepts and tell you how you can incorporate them into your own options trading. And today we're going to hit back on a topic we discussed last, probably about a year ago. It was a very, very in-depth topic. You guys may have checked it out. You may remember them from our previous episodes. If you haven't checked out those archived episodes, let me point you to them. We're going to talk about some more about adjustments. It's a very, very hot topic. It's a very, very, you can go on for days about this one topic, because like anything that has to do with anything subjective, there are myriad ways to do it. There are some arts and some sciences all combined into the subject of adjustments, and we're going to get into some of that today. If you want to get the the big, deep discussion on adjustments that we had. We actually did 2 episodes on it, and it was from last year. It was February of 21st of 2014 and March 6th, episode 40 and episode 41 of this here program, Options Bootcamp. We did basic adjustments, and then we did more advanced adjustments. And if you're not familiar with that concept at all, again, I encourage you to go check those out. But also, let me just give you a quick rundown. What we're talking about, what we mean when we say adjustments is, of course, you can put a trade on. Anyone can put a trade on. Anyone can go out and buy a call or sell a put or whatever the case may be. But then what do? You can't just put it on and set it and forget it, as they used to say in the old Ronco days. Really, you need to do more than that. And it seems like when we talk to a lot of retail traders, this is where a lot of them tend to have a lot of difficulty. And that's because it's a very difficult topic. It takes a lot of experience with the market to really understand how to adjust effectively for your portfolio. I mean, there's a lot of different ways you can adjust. There's, of course, the most obvious adjustment, which is the biggest of all, take it off. You can just take, this is not going my way. I'm going to close out this position. That counts as an adjustment. Then, of course, you can do things like maybe you cut your position in half because it's not really working out for you, or maybe it is, and you want to take some gains off the table. But you don't want to take all of them off the table. You want to have still a little bit of skin in the game. So you take half of it off, take some profits, keep the rest on the table. Or you can roll. We've talked about that in the show before. You roll up to a higher or lower strike, depending on what's going on in the underlying. So there's a lot of different ways you can adjust. You can roll the different strikes, add months. You can roll from one month to another. There's a lot of different ways you can adjust in the options world. And it becomes an interesting topic that you can really sink a lot of time and a lot of effort into. Again, I encourage you for the full rundown of adjustments. Go back to episode 40, episode 41. You can spend 2 hours with us diving into that topic in a lot of detail. But before we get into the specifics of today's topic, which are going to be the kind of interest rate income adjustments types, Dan, you have any opening thoughts you want to hit on about adjustments in general? And it's been about a year since we talked about these. So anything you want to hit on that maybe we didn't hit on last time, and then we'll get into the world of interest rate and income kind of trade adjustments.
Yeah, one of the things that I just kind of want to predicate this whole discussion on is that the fact that adjustment trades are both the absolute most important part of option trading and the single most overrated part of option trading. Managing, and I think I've said this on the show a few times, managing trades, how you exit a trade ultimately determines whether you make or lose money. So incredibly important. And adjusting is a big part of that. You have a great deal of control over the outcome of your trade. You can't control the market, but you can control how you handle the trade. Good traders are good at managing those trades and adjusting and doing these different things. Now, that being said, they're not magic bullets. They can't solve, all your problems. They can't guarantee that every trade's going to be a winner, but man, they sure can help. So this is going to be a really great conversation today. We're talking about really important things, and just keep it all in perspective, and I think you're going to get a lot out of this.
Yeah, let's dive into it a little bit then, because we're going to talk about probably a little bit more interesting, a little bit more dangerous aspect of the adjustment game today. That is the adjustments on the income side of the equation. If we're trading options for income, that means we're selling options, which means we're playing on the short side, the dark side, if you will. And that's where adjustments really come into stark relief for a lot of people. You can adjust or not adjust when you're long premium, and that'll decide whether you make some of your money or whether you lose all your premium. Certainly losing it all is not a good thing. But on the flip side, on the short side, on the dark side, that's where you could lose potentially a lot of money if you don't adjust correctly and don't know when to adjust correctly. So we're going to hit on this a little bit. Again, we touched on this before on our previous episodes. Go back, particularly to our episode 41, our advanced adjustments, if you want to dive into these in a lot more detail. But we're going to hit on a few salient facts because we didn't really dive into the income portion of the story when we were talking about it last time. The setup for a good income trade is pretty obvious. Everyone knows it. Everyone who's read a basic options book and has seen the expiration graph that they all show you knows what the ultimate max profit point is. Of course, you sell an option. Let's say you sell an out-of-the-money call and you long the underlying, so you have a covered call on. The underlying rallies to that strike where you sold it and then just sits there perfectly and doesn't move until expiration. That is the ideal max profit scenario for your trade. What happens if that doesn't happen? That's a little bit where we're going to get to today. I think covered calls, maybe we'll start there, Dan, because that seems to be one of the more contentious areas of adjustments. I've said this before on the show. I think it's worth repeating that I think people need to understand. I think your point about maybe adjustments are overdone is worth repeating here, because for covered calls, sometimes, particularly if you're doing it the month in, month out, or maybe even on the weekly cycle, and you're doing it very aggressively, it's not the end of the world to have your stock get called away. I see people scrambling. I see people really going crazy, trying to roll, spending a lot of money to roll up to a new strike, close out another strike, just because they're terrified of having their stock called away. And sometimes there is a real rational reason for it. They have some sort of prohibition against selling their underlying, or perhaps tax consequences. But those two reasons aside, sometimes it's a good thing to have your stock get called away. The underlying moves to your strike, maybe a little bit beyond, but you had the underlying the whole way up. You keep the profit you sold for that call, and then whatever it goes beyond that strike, that's you don't get that in the underlying, but you hopefully made that consideration, made that decision when you set up the trade, because you chose a strike where you were comfortable selling the stock anyway. You see people make that decision all the time. Yeah, I'm comfortable selling here. Then the underlying gets there, and all of a sudden their rationale changes, or they don't want to give up on more upside, and they end up costing themselves a lot of money. Would you say this is a common occurrence with a lot of your students? They perhaps over-adjust on the covered call side of the fence, when in reality they should probably just let it go and reestablish again?
Yeah, unless you have some sort of tax consequence or some real valid reason for not wanting to sell the stock, if you get a sign in your call and the stock gets called away, that means you just made money. Like that's a good thing. That's fine. There's nothing wrong with that. So I do see a lot of over-adjusting when it comes to covered calls, but usually I think it's because of unnecessary panic.
Yeah, you think they'd be excited. Hey, my underlying is going my way. I was right in my estimate. And yet that often seems to be a source of panic for some reason. I never really understood that. I think it probably plagues the longer-term covered call trader a little bit more. Again, this is why we kind of urge you, if you have the time and the wherewithal, to migrate your covered call and most of your income liquidity to the shorter end of the spectrum, the higher decay portion of the spectrum, instead of riding that 1 year leap, for example, and then setting it and forgetting it, because then you're going to have to roll if you want to keep that position on. Otherwise, you're stuck with having maybe many months of losing underlying appreciation in that underlying. So it's a case-by-case basis. But in general, I think the first adjustment I would caution a lot of people on the covered call side is to maybe not do anything. Let your stock be called away. If you have a very short-term call, a 1 month or less, let the stock get called away. Unless there's something crazy has changed in the underlying, you can reestablish again once that position is done and expired, and then you could do it all again. And that's the nice thing about short-term covered calls. You can keep adjusting on a regular weekly or monthly basis, depending on how frequently you write those calls. So maybe the frequency of your trade should really be considered part of your adjustment strategy, because at the end of the day, if you're trading frequently, the compelling reason to adjust isn't there versus the massive 1 year, one and done type trade where you kind of have to babysit that because it's the only trade you have on, and you're not going to do another one for a long time. So that's an interesting thing. Any other caveats you can say about covered calls, Dan? Maybe obviously when the underlying blows aggressively through your strike, you have a longer term covered call on, and maybe your underlying viewpoint has changed. That's certainly a time when you may want to consider rolling. Do you have any sort of rules of thumb you use when you say, hey, this is when I want to consider rolling? Any percentage profit or any percentage near your strike, or are you more of a set it and forget it guy when it comes to covered calls?
Yeah, I mean, I think covered calls they're an investor strategy instead of a trader strategy. So I think that they're designed to be a lot more passively managed. I mean, if you're trading your covered call position, every other day, like, you're doing it wrong. I think the times when you adjust are when your thesis is wrong. Like, that'll be the recurring theme. Every adjustment we talk about today, it's going to be when your thesis on the trade was wrong. And the way you know it was wrong is you put the covered call on today, it's a 1 month covered call, and, within a few days, the stock either drops a whole bunch lower, which you didn't expect, or blasts through your short strike, which you didn't expect. And then that's when it might be appropriate to make some sort of adjustment. But, if things are working out great, the stock is drifting up to your strike and it, makes it a little bit through your strike a week before expiration, well, you're doing great, man. Just stick with it and you're doing fine.
I'm going to get a copyright infringement notice from the Ronco people if I keep using that term, so Maybe I should move on from it. But does apply here, particularly in the covered call mindset. There's a reason why so many financial advisors and others really like this trade. It's kind of a one and done type trade. You put it on for a month, or sometimes they usually use a quarter. That seems to be a period that they like in terms of not having to manage it as much. You're not doing as well from a decay perspective, but that's kind of their balance between a 1 year call that doesn't perform as well and a 1 month or even weekly call, which requires a lot more work. They pick that quarterly call. They write a call 4 times a year and they're happy. So there's a reason why this strategy is so popular with the set it and forget it crowd. But of course, the other side of this fence, of course, we talked about on this show before, the risk equivalent position from a covered call is, of course, a short put. And when you get into the adjustment landscape there, that becomes a little bit of a different story. We've discussed using a naked short put as a way to get paid to get into a long equity position. And in that scenario, in that kind of investor scenario, as Dan likes to refer to it, the adjustment there isn't really necessary because you've already made that decision to say, hey, I want to get long. It's the same thing as working a limit bid in the stock. You get hit there, you get hit there. You're getting filled on that stock. Unless there's a massive gap, huge earnings change or something like that in between when you set that trade up and when you actually get assigned, that maybe may make you change your fundamental outlook on the underlying. And that's a conversation for a different day, fundamentals and technicals and all that fun stuff. But if you're in that investor mentality and you've already done your due diligence going into the naked short put trade and say, hey, I'm going to sell this put at this strike and I'm comfortable buying the stock there, then you've already made your adjustment. You've done your due diligence ahead of time. You've bought the stock at a level that you're comfortable with, hopefully substantially below where it was trading when you first wrote that put. And so you got a decent discount for your efforts, as well as collected some premium to do it. So in that case, your adjustment was made ahead of time, and you have this underlying position now, and then you can decide what to do with it going forward. We've recommended in the past a wheel trade if you want to wheel out of it. A lot of different things you could do. You can get into other maybe repair type trades if the underlying is going to rally. A lot of different things you can do with that. What about, Dan, in the scenarios where people are, like you like to describe them, you put them in the investor and trader buckets. What if they're more in the trader bucket? And so now they're writing short puts, let's say, in the monthlies or in the weekly realm. A lot of people love the weeklies. And then all of a sudden it starts moving against them. It starts going toward their strike. When do you start making that adjustment consideration in your head? Think of it again. You're a trader. Is there some rule of thumb you like to use? Like, say, it gets a certain percentage range close to your strike, or perhaps a certain percentage of loss you will deal with ahead of time? And is that when you make your adjustment? Or when do you start getting the itch to adjust is probably the best part of the question.
Well, I think it's a combination of a couple of things, and different traders handle it differently, and I kind of allow my students to use their own techniques on this for themselves, but I guess that just kind of makes it easier for me now to give a couple different perspectives, really. One, when you're looking at selling a cash secured put, or naked, I guess, but I prefer cash secured and for sure. I like taking profits when you can take about 75% of your max profit. So as far as taking a loss, it's got to be less than it, If you sell a put for $1, if it becomes worth $1.40, I'd say 40% is maybe a pretty good threshold there to say, all right, I've lost enough. I'm willing to accept a 40% loss. I'm out. And by 40% loss, I mean 40%, like the premium that you sold the put at, it gains 40% in value. So if I sell it for $1, I close it at $1.40. There's one technique, but another thing to consider, and I would go as far as saying this is maybe even a little bit more important. When you put on a short put, the reason you're doing it probably is because you see support in the market. I can't think of too many other good reasons to do that. If there's not support in the market, you pretty much have no business selling the put because that means there's nothing technically holding the stock up. So you have a good chance of loss in that scenario. So I think if the stock violates the support level that you've been counting on, if the stock violates the support level you've been counting on, then I think it's great to, close it and say, hey, look, this is what I was counting on holding. This is why it was a good trade. Now I can't count on that, so now it's not a good trade. it's time to adjust it or take it off entirely, for that matter.
I think it's worthwhile reiterating that point as well. Just in general, a lot of people think they have to be sitting by their screens, 9 to 5, not have a day job, not have a life, and babysit their positions all the time. And certainly that could help in some crazy scenarios. But in reality, a lot of these positions we're talking about, a lot of these adjustments that we're talking about, you can do them ahead of time. And that's kind of the nice thing when you're establishing these positions. Like we're talking about here, Dan was just throwing out that 40% number. That number may vary depending on your own risk threshold, your own risk tolerance. But whatever that number is for you have to make that calculation for yourself. Again, you do that math ahead of time. You look at the strikes when you're selling a naked short put. You look at where you're comfortable buying that stock. Write that strike there. You look at and once you put that trade on, once you get hit on that stock, you start to adjust and say, okay, here's my pain threshold, and you could work a limit order even then. Say, hey, I'm going to get out of this stock at this level, and also probably good on the other side if you want to keep that option on and not get assigned on the stock. You can also work a buyback price as well. Say, hey, I'll buy it back if it gets to this level. I don't really decide I want the stock here anymore. So these are all adjustments you can do kind of ahead of time for the most part. And then, of course, if you're really worried about really bad gaps when you're writing these puts, a lot of people prefer, I should say, really to never be naked short units when it comes to options. So instead of selling a put, you sell a put spread. Of course, that limits the amount of premium you're going to collect. But if you're worried about that 1 in 100 scenario like we saw with the Swiss franc recently, crazy things can happen. If you're worried about that perhaps happening to you, coming back to bite you, then a put spread will, of course, mitigate that potential loss you have in there. So there's a lot of things you could do ahead of time to make it a little bit easier on yourself. You don't have to worry about frantically trying to adjust on the day. And if you sit down and you kind of lay out these rules to yourself and you put together your little rule set ahead of time, the adjustment process becomes a lot easier, a lot less overwhelming to you. You don't really need to sit there and now you're looking at some crazy position. How many times I've seen people come to me and say, hey, I bought this and then it rallied, so I sold this, and I came back down and I sold some of this some more, and I bought this over here, and now how does this look? And they hand me this crazy hodgepodge of just all sorts of strikes, longs and shorts here. It's hard to even make heads or tails of whether they're net long or short any units or what the hell their actual intent of the trade was initially versus what ended up becoming this kind of Frankenstein's monster mess. You don't want to fall into that scenario. It is very easy to overtrade and end up costing yourself more money, both in time and commissions, as well as lost profits. So at the end of the day, if you do some of these simple math, some of these simple thought processes we tell you about ahead of time when you're putting these trades on, that will help you and go a long way towards when you want to and feel the need to adjust. Is that kind of how you counsel your students as well, Dan? You tell them the lion's share of the adjustment can really occur ahead of time, or as opposed to kind of babysitting on a minute tick-by-tick basis during the actual trade itself?
Oh, yeah. I mean, you cannot make good decisions in the heat of the moment, That's like, you're having an argument with somebody and, you just get really angry and this idea comes to say something and you think, what, maybe I should just hold back and maybe not say that right now and really think it through and talk about it when I'm not so angry. Like you have that same relationship with your trades, like when the time when you adjust is when it's going against you. And those are the times when you're probably not so happy with your position. So trading in anger, nothing good can come of it.
Yeah, it's probably a good advice for lots of things in life.
Yeah. I mean, it's always good. I mean, one of the rules that I give all my students is before you enter into a trade, A, where you're going to take your profit, B, where you're going to make your adjustment. You approach it like that, and it becomes mechanical. It's not emotional. It's so much easier to do. I mean, you would be surprised and amazed that, when you've got your plan, you know exactly what you're going to do. It's easy to follow your plan. And then win, lose, or draw, you might be upset if you lose money, but you're not going to be as upset if you end up getting whipsawed because you panicked and you did something ridiculous because you were angry. So, yeah, plan in advance and you're all good.
Not really, kind of hard to rhyme with advance. Plan in advance, you won't be in a trance when you trade. How about that?
Do your happy dance.
There you go. I like that. It's even better. I like it. There you go. That's why you tune in, listeners, to get our quality rhymes. Speaking of the listeners, I want to make sure you guys have some time to make your comments, your insights known here on the old program. So without further ado, we're gonna wrap up the adjustments talk there. Again, we can do that a lot. We can talk for hours about adjustments, but I wanted to kind of put that out there. Some people had asked about income adjustments and how they relate to the other adjustments we were talking about, and they're pretty much very, very straightforward, particularly if you use that mindset we just said, where if you kind of set it ahead of time, lay out your parameters ahead of time, that's the lion's share of the adjustments that you really need to do. Unless you're really getting into some very, you're looking at doing, delta neutral volatility type trades and that sort of thing. That's a little bit more advanced in this type of program, but in general, for the lion's share of the listeners out there who are looking at these products as a short put to get into stock or a covered call to get income from stock, these are certainly things you could set up ahead of time and make your life a lot easier. Again, for more information on adjustments, a whole other 2 hours worth of adjustment talk, tune into episode 40 and 41, and you can get a lot more fun on the adjustment side. Meanwhile, we're going to dive right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, first up here in the old mail call, we got a comment, actually. This comes from Dmitry. I don't know how to pronounce his last name, so I won't insult him by trying to pronounce it. He had a nice, fun little comment. I figured you'd appreciate this, Dan. He writes in and says, there's no V in the Greek alphabet, so how come Vega is considered a Greek? Who started this madness? And, I thought that was a good comment. I never thought of it that way before.
Dmitry, sounds like a Greek name. We better tread lightly here and make sure we answer this question correctly. Yeah, I have thought about this one before because I've had many discussions on the Greeks, and it's just, I guess, what I would call a bastardization of, it kind of sounds like theta, sounds like a Greek letter. And, obviously it sort of stems from V for volatility, right? So we're trying to work that V in there to make it a alliteration or something, I guess. I don't know. But it is true that there are also some Greek letters that are used alternatively instead of Vega to represent that exact same thing. It's common, especially for pretty old school traders, to use kappa instead of the word Vega. It means the same thing. I have also heard people use omega. I don't really understand where that comes from or anything.
Wow.
But
is that Charlton Heston using that one there?
yeah, that's right. Yeah, Chuck and I were chatting one day at the gun range. And
your many options mentoring sessions with good old Charlton Heston there?
Yeah. But, so there you have it. I don't know. Dmitry, I have no good answer for you, but I do have the only answer for you. It's just the bastardization to make a V word that sounds like it could be a Greek letter if it was.
Kappa, I think I've heard a handful of times. I don't think anyone's ever said omega to me. And if they did, I looked at them blankly. I said, what are you trying to refer to?
Right.
I would be very, very surprised. But interesting. That's good question. I think Greece is in the headlines a lot these days. We're getting all the Greeks are coming out of the woodwork with their questions. And so obviously Dmitry was deeply offended at how we connotate the Vega here in the States. Since we're on the Greeks tip here, and that is your bailiwick, Mr. Passarelli. Another question here comes from Brian Collamer. He had a much longer question about a bunch of different things, including theta. I'll just wrap up the end here with the theta part. He asks, don't out-of-the-money options decay the fastest at 60 to 70 days and then kind of flatten out? Great show. I wish it was longer. Thanks, Brian. This is an interesting question. Dan, we're always talking about that theta curve. I'm always encouraging people to really mitigate their liquidity, or I should say migrate, their liquidity into that near portion of the curve. You look at any theta graph and it's going to show you that exponential rate of decay is in that final 2 weeks of that option's lifespan, or in the case of weeklies, the final week, actually, because that's all there is. So that's where the maximum decay occurs. Of course, that's on a percentage basis. That's when the option is really decaying on a percentage basis down to zero. So even if it's, 3 cents in that final couple of weeks, it's going to go to zero. So the percentage decay is going to look like an exponential curve, even if the net amount of premium you're actually collecting is somewhat marginal. I haven't seen any data to back this up to say somewhere in that longer portion of the curve, sounds like in that 2-month or so range is where you're getting that maximum premium harvest. I guess that's what he's trying to imply here. I'm not really sure. Have you heard any data to back this up, or is he kind of just throwing this out there kind of willy-nilly?
I have not heard any data to specifically back this up. I mean, I have looked at, just graphs that I've run, and spreadsheets and that kind of thing. And I noticed, like, if you look at a typical options textbook, they'll say that in the money and out of the money options decay pretty straight lined, where near the money options have that curvature you were just talking about, Mark. But yeah, I mean, when I have sort of tried to graph it out, I noticed that maybe it's not exactly a straight line, and I don't know. I mean, maybe there's some merit to what Brian's saying. I don't know that necessarily to be true, but maybe. I mean, the fact of the matter is, though, it's not something like with near the money options. There is an incredibly drastic speed up of the leak out of time decay once you get into that last week or so. I mean, it speeds up profoundly. You definitely don't see that profound differential in the rate of time decay with out of the money options. It's pretty flatlined. So, that's about as much as I can comment on that, I guess.
Yeah, I have always looked at it in like that final 2 weeks being, of course, the place to maximize your trading, hence the explosion of interest in weeklies. But this was such a specific period he threw out that I thought maybe he had stumbled upon some data, some study somewhere that I hadn't seen that maybe showed that on a just pure amount of premium basis, perhaps, you might do all right in that time frame. But I'm glad to see you haven't seen it either. So I'm sorry to say, Brian, yeah, we still stick with that relatively flat line type of decay until you get to that nearer portion of the curve, that final 2 weeks or so. And that's when it really starts to go just crazy town, go near exponential. And that's when, if you're selling premium, you kind of want to be active in that range. All right. Since we're all Greeks today, let's go on to another question about the Greeks. Dan, I think we've chatted about this before, but I think it's a important enough discussion to worth revisiting. We've got a question here from Charles Patterson. He writes, is it accurate to describe delta as the probability of an option expiring in the money? And this is a common usage of delta. We hear it bandied about all the time. In fact, Dan, traders on the floor used to say, hey, are you going to go to that thing? Oh, I'm a 70 delta. It's just always kind of bandied about as a probability, and which is probably the incorrect usage of it, quite frankly. I have a lot of thoughts on this, but I think since you wrote the book on the Greeks, I will let you go first, sir. What's your take on this and the connotation of delta, not just being the rate of change of the stock, or excuse me, as the option as the stock moves, but also as the probability of that option expiring in the money?
Is it accurate? Technically, no. It's not an accurate description, but it's good enough for government work, as they say. It's sort of one of those things like, in the summertime when you're playing beanbags, or I guess in the South they call it cornhole, right? That's a game where you toss the beanbags in a little wood thing with the hole. Like, it's supposed to be a certain number of feet apart. I don't know what it is, 20 feet or something like that, regulation. But I've never seen somebody out, they put down their beer and they go get the tape measure and measure it out. Instead, they just sort of like count out the paces, and they get pretty darn close, I'd imagine. That's basically what delta does for you. It's a nice little handy-dandy rule of thumb. It's not entirely mathematically accurate, but it's nice to have that to lean on somewhat.
Yeah, there's a lot of great articles out there I could toss you to, and I think we've discussed some of them in the past. Some of them are linked on the Options Insider. There's a good one out there from a site called Risk Latte. Interesting name. They have an article called literally Understanding the Delta of an Option. And it gets into some of the mathematical parts, and it is a relatively intricate mathematical discussion to see the actual nuances of it. But the truth is, Dan is right. It is a good approximation, but that's really kind of all delta is. And it really, in some areas, it can actually be extremely extremely inaccurate when it comes to the actual probability of expiring in the money, particularly on some very, very volatile names. In general, if you're looking at a lot of these names, it's probably a good rule of thumb to just keep in mind that essentially, and also the takeaway on this article here is that the delta of an option is not equal to and may never even be close to the probability of exercise of an option in certain scenarios when there's a lot of other factors at work like volatility and things. And they kind of come away looking at, and once you go through all this math in the article, I encourage you to do so if you're really interested in this, that the delta of the option is pretty much always going to be greater than the probability of an exercise. So if you bear that in mind when you're looking at delta, that it's always going to be a little bit bigger at least, and sometimes demonstrably larger than what the actual probability is. And there's a lot of ways you can go through that. You can do, binomial pricing trees and all these other crazy things to try to derive the actual probability of that asset expiring in the money. But if you do that, and you run through some of these articles, or if you just search for delta and probability, you can kind of get the gist of some of that as well. You can see what we're talking about here. And it is kind of the old school usage. It's been around for a while, maybe not as old school as Omega, but it's still relatively old school. A lot of traders still throw it around there. It's kind of just been bastardized as kind of I guess you can call it a misreading of the Black-Scholes formula at the end of the day. It's not really what they intended when they talked about delta being this derivation of the Black-Scholes formula. Yet somehow it got this definition ascribed to it, and it's never really gone away. When I was learning options, I was taught that, delta had three definitions. It was, of course, the sensitivity of the options price to the underlying movement. It was the hedge ratio, which was important for a professional options trader to know how many shares of underlying or to hedge with you want to be delta neutral. And then, of course, the third was the probability of expiring in the money. So we were actually taught that. And as it goes along, you start seeing these things unfold in real life. You realize that is not exactly the case. But a good question, and certainly one if you guys really want to dive into it and see the exact degree of differential. I encourage you to do just that. Let's see, we got time for a few more here on the old program. Here's a good one, Dan. I think you'll like this one. This one comes from Rohan. They write, do you think it's viable for an active retail trader to become a professional retail trader using primarily the freely available tools from the retail brokers? How viable is that in the current environment? Would I always be at a disadvantage from the pros picking me off? Is this just a pipe dream? How much would you say the average pro trader needs to make to be viable? Thanks again for all the great programs you guys have put out for free. Well, Dan, I'll let you go first on this. And this is kind of the entirety of your business, is training retail people to be self-sufficient and perhaps even become pro traders. So what do you have to say to our friend here, Mr. or perhaps Mrs. Rohan?
Yeah, it's definitely possible. I've done it before. I've trained very active, very good retail traders, and they've gone to become professionals. A couple caveats, though. One, first of all, you got to be good. If that becomes your job, you have to make money. How much do you have to make? Well, you have to make enough to cover your expenses and to make enough to live on. If you have expensive taste, you got to make a lot. If you're a relatively simple person, you don't have to make a lot. That's all relative. And I know some traders, like, for example, some futures traders out the border trade in the grain pits who, their goal is to crank out $2,000 in the morning, and as soon as they make $2,000, they go home, or something like that. Maybe it's $1,000. Maybe it's more modest. And then I know some traders who make millions. So, that part, that's subjective. Now, as far as the tools and such goes, yes and no. The first thing, you would need portfolio margining, because you can't trade professionally with Reg T margining. It's just not possible. But as far as like platform tools and that sort of thing, generally speaking, the platforms, like the really good options platforms that are out there, I think I'll just be political and not really mention any names, but the really good options platforms, in a lot of ways, they're way better than what, well, I think I can speak for both Mark and myself, what Mark and I were using when we were professionals down on the trading floor, and we were paying thousands of dollars a month for software that was not half as good as what most of you guys get for free.
Oh, yeah, it was orders of magnitude worse than the stuff you get for free these days.
Yeah, but, the only one thing that you're somewhat disadvantaged by, like all the tools and everything were great, but it's more the feed. I think that most of the online brokers, you don't get exactly as accurate a feed if you're a few microseconds delayed, theoretically you're at somewhat of a disadvantage. Now, it might not be the end of the world. It depends on your trading style. I mean, if you're doing volatility arbitrage trades and holding them for a couple of weeks or something like that, it might not be the end of the world if you're a penny off here or there. You don't want to be a dime off, but it might not be the end of the world if you're a penny off here or there. And you are taking a position. And so if you like the price you're trading at, then you like the price you're trading at. So that's fine. And then the one other thing also is that on almost all retail-based options platforms, implied volatility is wrong. It's just wrong. It's just fundamentally calculated incorrectly. So what you would need is you need to be able to input your own implied volatilities and do it in such a way where it changes dynamically. You can pick up a professional-based software package, a platform, and you can pay money for it on a monthly basis, which means that ups your costs, which means that ups how much you have to make by the end of the month because you got to cover those costs. So I think that would probably be what you would have to do. You'd probably have to pay for a professional platform. I mean, the retail ones that are out there are really, really good, but they've got a couple of shortcomings that you probably want to get over.
I agree. I think that there are two shortcomings on these retail platforms. It is in the data feeds, and indeed in some of the metrics they calculate, volatility certainly being one of them. I'm familiar with a lot of those packages you're referring to. I think if people are willing to dive into the deep end of the pool and they're willing to become professional retail traders and they don't mind a little bit of added cost, some brokers will actually kind of try to package this in for you, give you some sort of bulk deal if you want to buy some sort of advanced data or statistics package from them. They could provide that for you for an extra fee, and that could maybe save you some of the effort. Or you can go out to some of these third-party vendors. There's a lot of them out there. iVolatility has volatility right in the name. LiveVol has volatility right in the name. I use both of those. If you're more on the futures options side, then maybe the quick strike guys are the place for you. Depends kind of what products you're trading, but there are a lot of vendors out there, and you can get most of those for they're pretty decent packages for a couple $100 a month, depending on the vendor and the kind of the platform and the tools you're looking at. So it's not an inordinate expense to add to your. If you're gonna be a professional trader, you can probably cover a couple $100 a month worth for these software packages. And if you go down a lot of the prop shops these days, and here in Chicago and other places, you'll see a lot of these guys are running those packages on the side alongside their screens. You'd be amazed. A lot of the retail people, I think, have this illusion in their head of these options professionals, these market makers have these elaborate systems. There's certainly all these big firms do on the risk management side, and the guys who are doing like the volatility arbitrage and stuff. But the guys who are the day-to-day prop traders who are in there trying to grind out and make a living, they don't have much more than you guys really do at the end of the day. They get a data feed, they get a seat at the table, they get a cut, and that's pretty much about it. And everything else they kind of have to provide on their own, including those software packages we just mentioned and all the other things to try to help give them an edge in the marketplace. So in that sense, you're not that far off from a high-end professional. Of course, they have that favorable margin treatment Dan mentioned too, and I wouldn't really overlook that. That's an important thing. We've talked about margin a few times on the show in the past. It kind of really refers to how much capital they're going to put aside for you and how they really treat positions that should be seen as offsetting, but if you don't have the portfolio margin Dan was referring to, then you're not really going to be seen as offsetting, and so you're going to have to tie up more capital as a result. So portfolio margin really is a much more elegant way for you guys to make maximum use and maximum efficiency out of your trading capital. And certainly if you want to be a professional trader, that's certainly a consideration for you. And the other part, about how much you need to make, again, Dan's right, that's just how much you need to live. I think the one thing people forget about when they're doing this and say, I want to become a professional trader, they forget that this is now your job. This is where this trading account is kind of everything for you. This is where your income is coming from. This is where all of your expenses are going to have to come out of this account. So you may be a decent professional retail trader making $60,000, $70,000 a year. That's a pretty good return for a retail trader. And now all of a sudden, because of your expenses, your mortgage, everything else are coming out of that same account, all of a sudden looks like you're pretty much flat on the year. That could be demoralizing for a lot of people because they have to keep kind of chasing that endless withdrawal rate they have in their thing. But as long as you can handle that mentally, then I think you could do very well with the platforms that are out there today. It's certainly orders of magnitude more viable of a proposition than it was 10 or 15 years ago when it was really expensive to trade. The markets for retail were terrible. You had to call up to get a lot of these trades done. It was slow. They were illiquid. There was no linkage between the exchanges. So you can get run over left, right, and center. A lot of them were still pit traded predominantly. It was hard to get access to that liquidity. The tools were just arcane. It was a terrible environment for retail. So compared to that, today you can really do very well as a retail trader if you know what you're doing, and if you listen to a show like this, as well as all of the other programs on the old Options Insider Radio Network. I think we have time for one more here, Mr. Passarelli. And since they mentioned you in the question, it's worth bringing up here on the show. This question comes in from AVG. They write, I heard Dan Passarelli, and they misspell your name, Dan, so don't take offense, talking about Goldman telling people it's not worth it to sell the S&P puts anymore. Do you guys agree with that sentiment? I think this comes from a recent episode you did, Dan, of Options News Rundown, where Goldman put out a study saying that the average amount of premium you're collecting for these downside puts in the S&P isn't really that remarkable anymore, and it may be worthwhile to hold off on selling some of those puts. So, A, Mr. Passarelli, do you recall that episode? It was very recently. Hopefully you do. B, what do you think? What do you say to our friend here, Mr. or Mrs. perhaps AVG? Do you agree with that sentiment out there?
Yeah, I do. All option strategies are not always appropriate. And for the last 2 years, selling puts worked out swimmingly overall. There were some pullbacks in the market, of course, where maybe you had to sweat it out a little bit or adjust or something. But, man, if you've been selling puts, or I would prefer put spreads, but if you're selling puts for the last 2 years, man, you killed it. But now it's not nearly as attractive anymore because, they're not as juiced as they should be relative to the actual volatility of the markets. And I would also assert, I don't know if this is necessarily Goldman's assertion, but I would assert that the risk of the market moving downward is certainly a lot greater than it has been for the last couple of years with the tapering of quantitative easing and all that sort of stuff. So I wholeheartedly agree, yeah.
Yeah, of course, there's a lot of factors you have to weigh, guys, when you're out there blasting out puts, as I know a lot of you are want to do. We've talked about implied volatility many times on this program, and certainly that level is coming off. Goldman was specifically referring to the SPX options, the S&P 500, of course. One of the best barometers for seeing that very easily is indeed the VIX, and the VIX, of course, if you've been watching it, it has spiked of late, but then it's coming off again. But of course, if you're watching these puts and you're watching the VIX and watching these other products, you'll know a lot of other things are at work out there that make it less than favorable to sell puts right now. As Dan alluded to, the market is, shall we say, a wee bit top heavy right now. So there probably is a decent amount of concern. People out there who put away a lot of profits in the market over the past year or two that they want to maybe protect those gains. So going out there and writing puts right now, it may be a little bit concerning because there is in the minds of some people, at least, a high probability of the market turning down. But of course, what Goldman was referring to was the actual amount of return you're getting, and that, of course, is reflected by the relatively low levels of implied volatility out in the marketplace. And implied vol is comparatively low. It's not overall low compared to realized. We can get into that conversation for another day. But in general, the level of return you're getting, I think they said in the article, somewhere around the mean. So you're getting about the average rate of return, which is not terrible, but you're not going to run out and blast away at them just to get the average level of return. Another good way to see this for yourself, listeners, is to go out there and look up something called the CBOE skew index. This indicates, what we talked about on the show before, volatility skew. And this number, in essence, shows you how expensive, how rich the puts are in terms of volatility premium compared to the calls. And that's a good barometer to keep an eye on if you're out there blasting away on S&P puts on a regular basis. And right now, in spite of the fact that the market is fairly top-heavy, has been rallying pretty aggressively, the skew index is actually surprisingly much lower than you probably would think it would be, given all these other considerations that Dan was just mentioning. You think people will be out there gobbling up puts perhaps a little bit more than they are. So maybe this is a time to think of it in the flip side, actually. If even a big house like Goldman is out there telling you be wary of selling puts, and if you have a lot of profits in your portfolio, you're perhaps worried about a little bit of a downside correction, don't want to give up any of those puts. You're seeing things like implied volatility in the S&P is comparatively low. You're seeing things like the skew index is comparatively low. Maybe it's time to actually think about buying some puts and actually putting on, or some put spreads, and putting on some protection against that worst case scenario if you do indeed agree with that. So in short, Dan and I think both agree with that consensus. and there are a lot of interesting metrics you guys can use to evaluate that for yourselves. But unfortunately, that's all the time we have for the mail call. It's also all the time we have for this episode of Options Bootcamp. We love to have you guys writing into us. Keep them coming. We'll hopefully get more episodes cranking out for you guys, so you guys have more chances to interact with the show. I know you guys have been writing in saying, hey, we want more episodes. We'll get them to you. Don't worry. But in the meantime, Dan, before we wrap up here, what's cooking in the land of market taker that may interest our listening audience?
Oh, we've got a lot of great stuff. We're going to make a formal announcement probably as early as next week, but our annual in-person event this year will be in Napa Valley, California. And that is going to be super, super fun. Details to follow. If you are interested, make sure you visit markettaker.com and opt into our email list. You can do that by just simply signing up for our free newsletter or our free options reports. And keep an ear out. This is going to be our best annual event ever.
Well, that's very nice of you. I wasn't expecting an all-expenses-paid trip to Napa Valley and a premium ticket to the wine train. That's very nice of you. I really was not expecting that. So I'll be looking forward to that.
Keep not expecting it.
All my premium wines. It's going to be a really great trip. You're really going above and beyond, sir. I'll make sure I put you on my Christmas card list for that. All right, all kidding aside, Mr. Passarelli, it sounds like a great event. Surf on over to markettaker.com if you'd like to learn more. And on behalf of Dan and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and, of course, for sending in such great questions. Keep them coming, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.